Hello, I'm Tom Robinson. I'm Director of the Financial Planning and Wealth Management Program at the Costello College of Business at George Mason University. Today, I'd like to talk to you about the 7-step financial planning process as recommended by the CFP Board. So, as a CFP professional, a certified financial planner, you have to follow a rigorous code of ethics and standards of conduct. For example, one of those standards is that you must always act in the client's best interest. You have to exercise due care when you're doing financial planning. And so the CFP board has put out a guide to the 7-step financial planning process that's primarily designed for solo practitioners, people just getting started out that may not be with a firm that already has an established process. This is not a process that every CFP must follow religiously. This is a recommended process that's based upon the elements that are in the Code of Standard. Individual firms may have processes that are a little more complicated. For example, a lot of CFP professionals practice where they spend a significant amount of their time in investment management. And in that case, one of the key elements that they would likely add to the process is having a very firm understanding of the current economic and market environment. And that's not explicitly shown in this process, but it is typically a part of the process that's included when the financial planner is doing investment management. So we want to look at the very high level, what the 7 basic steps are in the financial planning process and how they will help you do everything you need to do in exercising that due care that's required as a CFP professional. So step number 1 is understanding the client's personal and financial circumstances. Also, as I mentioned, if you're in investment management, you may include their understanding the current market and economic environment. And we're going to go through each of these in a little bit more detail. Step 2 is identifying and selecting goals. So based upon the client's personal and financial characteristics, what are the goals that they are desiring to achieve? And sometimes people know what their goals are, sometimes they don't, and you have to help them develop those goals. And then based upon steps 1 and 2 and step 3, you analyze the client's current course of action, so what they're currently doing, how much they're saving for retirement, how much they are saving or not for their kids' education, and look at that relative to their goals and determine if they're able to meet their goals with the current course of action, or you identify potential alternative courses of action that will better enable them to meet their goals. In step 4, based upon the work in the first 3 steps, you're going to develop recommendations for the client. And then in step 5, you're going to present those recommendations to the client. You may actually end up looping back if, as part of the process, the clients tell you that they may not be able to implement the recommendations, or they may be able to implement some and not others. You may have to do an iteration or 2 at some of these steps to help refine the goals and make sure that it's a plan that the clients are comfortable with. Once you have agreed upon which recommendations the client would like to implement, the next step would be implementing the financial planning recommendations. In some cases, some of those pieces of implementation are going to be done by the client. Some are going to be done by the CFP practitioner. Some may be done by other professionals, lawyers, investment managers, and the like. Once they've been implemented, then you're periodically going to monitor how things are going, whether the client is making progress through their plans towards their goals. And then you're going to start all over again. So on a periodic basis, you're going to want to revisit their financial condition, because that's going to change each year as you go through the planning process. Their goals may also change. They may have decided they're going to have kids and they previously didn't have kids. They may decide they're going to move, seek a new job. And so you always have to stay on top of your client's financial circumstances and see when the goals need to be revised, and then you start the process all over again. So let's drill down a little deeper and talk about each of the 7 steps and what happens before they even begin the process. So the first thing is when you have a new client is you need to agree on the scope of engagement and what's going to be included in the planning process. In some cases, clients may want a comprehensive financial plan, and initially that's usually in their best interest. So you get a picture of everything that's going on and help develop their goals. It may be that they want you to do a piece of the process and maybe perhaps not do a comprehensive financial plan. So typically, in a financial planning engagement, it's very important to define that scope of engagement. So, create an engagement letter that basically talks about the services and products, if any, that the CFP professional is going to provide, what the terms are for payment, whether it's an hourly basis or a fixed fee based upon the financial plan. Are there any other fees that you may be receiving for products that may be used, and any additional costs that they may incur, such as fees for buying and selling individual securities. In particular, all of this, it's very important that the planner fully discuss how they're being compensated, because it is important that all of those things are disclosed and that you make sure that the terms are in the client's best interest. Typically, at this initial meeting or before the initial meeting, you also deliver some other important documents, your privacy policy, how you're going to handle the information you're getting from the client, and then any required regulatory disclosures. If you're an investment advisor that's registered with the state or with the SEC, you need to provide them with a Form ADV that talks about your firm, your policies. Your firm brochure would also typically be delivered along with that ADV. Later, after you've gone through the planning process, there may be some other paperwork that needs to be done if the client needs to open up a new brokerage account. And that's typically the financial planner is typically engaged in financial planning and perhaps investment management, but the client is also going to need to have a broker where their assets are going to be custodied at. And the planner can help with getting all of that paperwork done to open up the necessary accounts that the client needs in order to implement the financial plan. So the guide that the CFP board prepared has a hypothetical case. So the financial professional, the CFP professional, is Joe. He's a solo practitioner. He's practicing as an independent registered investment advisor. That means Joe is not a broker. Joe is not a salesperson. He's a CFP professional, and he's going to provide independent, objective advice and manage the client's investments if they would like him to manage those investments. The clients are Martha and Dan, both age 32, salaries a little over $100,000 a year each. They have a daughter, Emily, and no other dependents and no current plans for more children. They file a joint tax return. They're in the 24% marginal bracket, and they don't have a CPA that they're working with. They prepare their own tax returns. Recently, they've been able to pay off their student loans. They were also putting the amount into their 401k such that they got employer matching. But now that they've paid off their student loans, they've actually upped their 401k contributions to a higher level at 10% of salaries. They pay their credit cards in full monthly. They have an excellent credit rating, and they already have accumulated 6 months worth of living expenses in cash. Unfortunately, they don't have any estate planning documents, so they don't have a will. Their beneficiary designations on their accounts, such as their 401k, were actually put in place prior to getting married. So those are all things that is part of the process. The CFP professional is going to advise that they get all of those things updated. So this is a fairly basic snapshot. The CFP professional, after the initial meeting, is going to need to gather some additional data. So we're now in step 1, understanding the client's circumstances. So we need to get both quantitative and qualitative information from our client. We need to analyze that information. We have to make sure we have everything that we need. And if we don't, then we need to go back to fill in the missing information. We're going to ask questions of the client. We're going to listen to what they're saying. Listening is a very important skill as a CFP professional so that you really understand what their needs are and don't impose on them what you think they should do. You want to make sure that you're helping them develop their own goals. Typically, we're going to do this through an interview questionnaire so that we're going to be documenting as we go through it if we're doing it in person, or ask the client to fill it out in advance of our meeting. We typically are going to want to get supporting documents. So, for example, we typically like to get 3 years of income tax returns. The reason for that is to understanding not only what they've been doing the last 3 years, but since they've been preparing their returns themselves, there may be some deductions that perhaps they weren't aware they were entitled to. And typically you have a 3-year window to file an amended tax return. So we typically like to get at least 3 years of tax returns so that if we do find something when we're doing the analysis, we can perhaps make a recommendation that they file an amended tax return if it would benefit them. We're also going to need to get information on their employee benefit plan, so the 401k policies, how much they need to put in for employer match. We already know they've been taking advantage of that, but we also want to know what investment options are available within those plans, and then what the policies are for withdrawals when they actually retire. We're also going to want to get information on any insurance they have through their employers, as well as any private insurance policies they may have. This includes health insurance, disability insurance, life insurance. Also, in terms of their other personal policies, their homeowners insurance and their car insurance, to make sure that they have adequate protection in all aspects of their financial lives. Any loan and mortgage information on their home, how much they pay in real estate taxes, homeowners associations, and those types of things. If they have estate planning documents, wills, trust, and the like, we would also get those. We know from these particular clients that they don't have any, so that's certainly going to be a recommendation that they get all of those documents prepared by an attorney, and we would not typically prepare those ourselves, but we would definitely make recommendations as to which types of documents, wills, durable powers of attorney, living wills, and those types of things that every client should have. Typically, trusts are not necessarily going to be part of that unless it's a more complicated financial planning situations. After we have reviewed all of these documents, we're going to want to make sure we follow up and collect any information that may not be clear or may be missing to make sure we have a really good understanding of their circumstances. So I've talked about a lot of this already, but we're going to have some quantitative information from their brokerage statements, retirement accounts, employee benefits, and the like, but we also want to get an idea about their health, their family history, whether there are certain characteristics that they tend to live longer than normal or have particular ailments. We want to understand what are their values, what is it that they're looking to do, and that will help us determine with them what their goals might be. We'll also learn about what their aspirations are and what their potential earnings are in their current careers. In particular, we're going to want to understand their risk tolerance. So when we develop an asset allocation and an investment plan, we need to understand how nervous they are about the markets, how we can design a portfolio that will help them sleep at night. And then most importantly is trying to tease out what are their goals. Some are going to be obvious: retirement planning, planning for kids' education in this particular client's case, since they have a young child. And then we want to know specifically what's their current investments look like. So, what's their current course of action? How much are they currently putting in retirement plans? And all of that will help us develop the goals along with the quantitative information that we've gathered. Clients typically do not have their own financial statements. Occasionally, I've had a client that used Quicken or QuickBooks for their personal business or their personal accounts, and will come to you with financial statements that they've already prepared, which one of which is a balance sheet. It shows all of their assets, all of their liabilities, and then what their net worth is. Cash flow statement, on the other hand, shows the cash coming in, the cash going out. But most clients don't have that. And so, based upon all of the particularly quantitative data that we've gathered, one of the first things we're going to do is put together a balance sheet for the client, which shows the investments they have, the other assets such as their home, any automobiles, and then any liabilities they have. In this case, the Millers have a fairly simple balance sheet. They've got a home, they've got some cash in a savings account. Recall, they've got 6 months worth of living expenses they've accumulated there. And then most of their investments are tied up in their work 401k plans. And then they've got a small taxable investment account. Their only debt is a mortgage of $240,000. So their net worth, when you take all the assets, subtract those from the liabilities, they have a net worth of about $290,000. On the cash flow side, they both make just a little over $100,000. So we've got that income coming in. They spend about $20,000 a year on recreation and entertainment, another $23,000 a year in 401k contributions. So they're saving, as we noted earlier, about 10% of their income, which is great. They spend about $15,000 on vacation and travel. They make $15,000 in gifts and charitable contributions. They're still putting money away into their savings. They obviously are paying taxes on their salaries. So we've got taxes coming out. We've got the mortgage payments, the insurance payments. On a net basis, when we add everything up, they actually have unallocated cash flow of almost $35,000 a year. So they're already saving quite a bit, but there's additional cash that's available that they can then use towards their future goals. So, as I mentioned earlier, one of the things we need to assess is their risk profile. So, how much risk can they tolerate? How much can they sleep at night if the market drops by 20% or 25 or 30%? And that happens periodically. It's not uncommon every few years to have a market correction that could be 10% or 20% or more. The record to date in one day has been a 22% drop in the Dow Jones Industrial Average. That happened quite a while ago. Typically doesn't move that quickly, but it can happen. And what you want to understand is how much risk they're willing to tolerate. What's the maximum loss they are willing to take before they would panic and sell everything. And behavioral aspects drive a lot of investment return achievement. So the typical individual who's investing, because we are human, we have behavioral biases, and if we panic and want to get out of the market immediately and sell, oftentimes we wait until the market has recovered quite a bit before we're willing to get back in, and you basically locked in that loss. And so you want to have an investment portfolio where you're not going to panic, that you're willing to hold out and wait and see how the recovery happens. So we want to understand how much risk they're mentally willing to tolerate. That's risk tolerance. We also want to look at risk capacity. So even though you may have risk tolerance that's low, you may actually have a good financial ability to absorb a loss. So if you have a good balance sheet, you already have a lot of assets that you've accumulated and very few liabilities. If you have good cash flow coming in, you may actually have a risk capacity that's higher than your risk tolerance. So we're going to take all of those things into consideration to try and do an overall assessment of what type of investment portfolio would be most appropriate that fits with both their risk tolerance and their risk capacity, their willingness and their ability to handle risk. Another important factor is their time horizon. The longer you have until you need the money, such as retirement or planning for education for a kid 15 years from today, um, longer time horizons typically enable us to take a long-term perspective and not worry so much about the ups and downs. So it's very important to understand what their time horizon is. In this case, they're relatively young. Their retirement is about 35 years from now. They don't need the investment income. They have enough salary coming in to cover their expenses. And we learned from this process that in the past, they haven't changed their 401k allocations when the market has turned down in the past. So this particular couple has a long time horizon. They have a good risk capacity and they have a good risk tolerance. The next process is finding out what their goals are. So we're going to ask the clients. That's the most important thing. So we don't want to give them some hints. Just what is it that you're looking to achieve through this financial planning process? And then we're going to look at everything we've looked at and say, okay, are there any goals that the clients have missed? And then we're going to present all of those to the client and we're going to help them select and prioritize the goals. So in this case, the Millers would like to buy a vacation home, a second home, a lake cabin for $150,000. They want to pay cash. They don't want to take a mortgage out on it. They want to send Emily to an elite private university, which currently costs about $71,000 per year, and they would prefer that she's able to go there without taking on student loans. They'd like to retire at age 67. We're then going to make some assumptions based upon life expectancy, based upon their family history, based upon mortality tables that are available to see what the time frame may look like, how many years we would expect them to be in retirement, which is typically a fairly long period. Today, people live into their 80s and even 90s. And so you're typically planning for a retirement period that's perhaps 25, 30 years after they retire at age 67. You also need to understand the current economic environment, the current tax environment. You need to understand what inflation is expected to be between now and when they send Emily to college and when they ultimately retire. You also need to understand the capital markets and what would be a reasonable investment returns to assume when you're planning for how much they're going to end up accumulating based upon the amount they're putting into their 401ks and other investments. In this particular case, we have provided some additional goals. Joe has, the CFP professionals, to the Millers. First, they need to understand and make sure that they have adequate insurance coverage. It wasn't something that they mentioned, but it's something that we are going to want to look at as a CFP professional because that can derail any financial plan. If they don't have sufficient life insurance, disability insurance, homeowners insurance, we need to make sure all of those things are adequate so that they can achieve the other goals that they did explicitly mention. The next step, as we mentioned earlier, is they don't have really any estate planning documents. They need to have wills. They need, in particular, since they have a young child, they need to have the will specify who should be the guardian should something happen to the parents. And they definitely need to update the beneficiary designations at their workplace so that the insurance proceeds and the 401k plans will go to the appropriate beneficiary. Since those predate the marriage, they're not likely to include the spouse or certainly the child, Emily. A goal that they did mention is the lake cabin in 6 years. We're listing that as the third in order of priority because they really need to make sure the insurance coverage is there and the estate plan and beneficiary designations are made. because not having those in place could derail the other aspects of the financial plan. The next one after the lake cabin is the university costs for Emily. Some might argue, well, that should be number 3 instead of number 4. The thing is, Emily is going to go to school in 15 years. The lake cabin is more timely. They'd like to do that in 6 years, but it's a close call. It's going to depend upon how the client expresses those preferences, which one they want to do first. In this case, they're largely listed in the order in which they have time to achieve that goal. And so the last one listed here, 5, is accumulating the retirement asset. So they've got a very long period of time to do that, and they've already contributed substantial amounts to that plan and are doing so on a regular basis. So these are their 5 major goals that we want to achieve through the financial planning process. In step 3, we're going to analyze the goals, their current financial situation. We're going to look at what they're currently doing, the 10% they're putting into their 401k plans. They have not explicitly set up a fund for the lake house. So we're now going to determine if their current plan, their current investments, are going to be able to achieve all 5 of those goals, or whether there are alternative courses of action that we're going to need to pursue. In this case, Joe concludes that their current course has a low probability of meeting all of those goals. And so we're going to have to take some additional steps in order to meet those goals. So the 10 alternatives that Joe comes up with is, number 1, increase their property and casualty limits, which is the homeowners and car insurance, add some umbrella coverages that go above all of those for things like lawsuits that may occur related to their property and those types of things. Increase their life insurance coverage. We don't have the data here, but apparently based upon their salaries, looking at their current life insurance coverage, perhaps they only have a small employer life insurance policy and not a private policy. So they are both working, they're both getting a good salary. So it's important that both spouses be adequately covered with insurance. In this case, perhaps the wife had a good disability policy from her workplace, but Dan did not. So Joe recommends a long-term disability policy for Dan. They definitely need an estate plan. They should consider refinancing the existing mortgage. Perhaps interest rates have gone down. Start a 529 savings plan for saving for Emily's college. One of the alternatives to consider is delaying the lake cabin purchase, or perhaps to consider purchasing it with a mortgage rather than having to come up with all of the cash in a 6-year time period, and also save for Emily's college and also continuing to save for retirement. Since they have a fairly strong risk tolerance, you may consider adjusting their asset allocation to get more growth, perhaps, and a little less security, maybe a little higher allocation to stocks versus bonds. And in this case, Joe identified that the emergency fund that they've accumulated, which is great, 6 months is at the high end of recommendations. So typically we recommend 3 to 6 months in an emergency fund. 6 is certainly more secure, but in this case, it's in a low yielding bank account, and they can probably get a money market account or perhaps a CD that's fairly short term, but still paying a higher rate of interest. So these are all the potential alternatives. Joe is going to go through all of these. He's going to discuss them with the clients to see what their willingness is to partake in some of those. And then he's going to develop the overall recommendations to present to the client. So Joe's recommendations are immediately within the next month, they should increase their property and casualty insurance policies. They should go out and purchase the individual life insurance that's needed. They should refinance the existing mortgage because the rates are fairly decent relative to what they currently have. At the time I'm taking this, mortgage rates are actually up. So let's assume that the case is correct and that at the time this case was happening, there were lower rates available. In 1 to 3 months, they should obtain a long-term disability insurance policy for Dan. If it's available through his employer, that's typically an inexpensive way to go. But if not, they should consider a private policy because if either of the parents are disabled, that income would be disrupted. So a disability insurance policy would help replace that. They should start creating estate planning documents. We may need to recommend an attorney for them to work with, and they should notify their employers about what their desired beneficiary designations are. We're going to also in this time frame adjust their asset allocation to have a little more stock or equity allocation. We're going to increase the amount we're saving towards the cabin to $20,000 per year in order to try and achieve that within the 6-year goal. And we're also going to start funding the 529 plan. And fortunately, there's enough cash on their income statement in excess that they can put into that. We're going to move the emergency fund to a higher yielding account, but one that's still insured by either the FDIC or the National Credit Union Association. And then lastly, we're going to perhaps put a little bit more on our 401k. They're already doing a great job there. We're going to want to make sure we're meeting the other goals first. So the education and the cabin. But then after that, if there's still cash left over, then we may want to increase those 401k contributions, take advantage of that tax deduction, and accumulate more for retirement. So step 5 is presenting all of these recommendations to the client. We're typically going to deliver that in a written document. It could be an email. It could be through our secure portal that we use to communicate with clients, or an in-person meeting with a presentation that goes through all of the recommendations. You're going to support that with reports, graphs, projections of what things might look like. We're always cautious. We don't know what's going to happen exactly in the future. We don't know for sure what inflation is going to be. We don't know what investment returns are going to be with certainty. So we're going to need to make sure that we're caveating that these projections are based upon our current assumptions, and we're going to need to monitor them periodically. We're then going to go through the priority. We're going to spend a little bit more time on the ones where they may be optional. So the lake cabin in this case, it's important to them, but it is going to have an impact on the amount of money that's being saved for college and retirement. And then you're going to want to make sure that the client is comfortable with these recommendations. Ultimately, it's going to be their decision as to which recommendations are going to be implemented. Once they have decided what they're comfortable with, then we're going to need to work on implementing the recommendations, assuming that our engagement letter at the beginning, they want us to actually help with the implementation. And so we're typically going to have a list of all these things and which are things the client is going to do, which are things that the CFP professional is going to do, for example, managing the investments, which are things that we're going to help them do. So explain to them how to select an attorney, how to go about changing their beneficiary designations on their employer's plans. And then we're going to have a schedule, and we can tick off as we do each of these things, making sure that they've been properly implemented, depending upon who is required to do the implementations. We're also going to want to make sure that if they don't currently have a life insurance agent or an attorney to do the estate planning documents, we're going to want to make some recommendations. Typically, the best practice is to give them a few choices. So based upon people you may have worked with in the past, have a good reputation, have the appropriate credentials, you might give the client 2 or 3 people so that they can call them and interview them and pick ones that they're comfortable with. So in this case, this is the implementation schedule that we're going to create for the client so they can tick off when each of these things are done to make sure that everything was covered after the meeting occurred. In step 7, we're going to need to monitor how we're doing. So making sure all of those things are ticked off. We're going to need to be periodically reviewing their investment accounts, their 401k, their cabin account, their savings accounts, and seeing how those are doing, report to the clients how they're doing. It's going to be up to the client how much of that continuing work they want us to do. We may or may not be managing the investments for them. So it may be that they're going to have to periodically come back to us with their brokerage statements for us to evaluate, or if we're managing the investments, we will have access to those. And we would typically then report to the client on a quarterly basis how their investments are doing. On an annual basis, we're going to want to do a more thorough review to see if we're on track. On a yearly basis, are we making progress towards our plan? How much have we accumulated in the education account, in the home account, the cabin purchase account, rather, and the retirement accounts? It's going to be very important that we make sure the client understands that all of this was based upon their current situation. And if anything changes, if they decide to have a second child, if they change jobs, if they have a significant change in their desire to have the cabin versus the education or retirement, they need to let us know about that so that we can make sure that we rethink the plan and reevaluate the goals going forward. It's important that we document all of this. Today, most financial planners use some sort of customer relationship management program where they track client meetings, they keep all of the documents in, but you need to make sure that you're tracking everything, documenting everything that you've done, making sure you've delivered any regulatory documents that are required. Keep good notes because your memory is not going to be the best. So keeping track of client meetings. A lot of planners today are using AI, which basically records the meetings and creates a transcript, which you can provide to the clients as well as keep yourself to track down exactly what was said and who is responsible for implementation, and making sure you don't forget about anything that was important that came up in the conversation. Overall, you should have ideally a written financial plan. It could be a PowerPoint presentation. It could be a booklet that shows the plan. There's different feelings about how detailed that should be. Some clients are going to prefer not to read a 50-page plan. They may just want something that's 5 to 10 pages, but you want to make sure it captures as much information that you used in the process as is possible. Now, as we mentioned at the beginning, the financial planning process is never over. It's going to continue. So we've documented everything. We presented our recommendations. We're monitoring how things are going. But on a periodic basis, we're going to want to start over again. We're going to want to periodically, it could be every 1 year or every 2 years or every 3 years, reevaluate the client's goals. Certainly anytime there's a major life change, we're going to want to reevaluate the plan and make sure that that life change is not going to disrupt the plan. What do we need to change? But you should also periodically update that plan because your economic assumptions are going to change, the client's circumstances are going to change. And so it's really desirable every couple of years to update the client's financial plan. So I hope you found this discussion useful and it helps your understanding of the financial planning process. Have a great day.